Well, it looked like we're going to have another down day on the U.S. markets, but we did have a nice rally to end the session. In fact, most of the indices closed near the highs of their session, and only the Dow Jones Industrial Average ended up in the red. That was largely as a result of a downgrade of 3M, which is one of the higher price securities in the Dow, so it does have a bigger sized impact than some of the smaller players. Nonetheless, a strong day across the board. We do retain our bullish postures on the vast majority of indices out there. Tomorrow we do have some testimony coming out from Fed Chairman Jay Powell, so we'll see if that has a chance to move the markets. We also, of course, are entering into earnings season here within the next week or so as well. Now today, from a sector perspective, the strongest sector was real estate, and one of the strongest real estate stocks I've seen in quite some time will be the focus of our trade application example. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 9th, 2019. First of all, if you're new, welcome aboard. Go to YouTube, click subscribe to our channel, check out our description area where you can sign up for our email distribution list to be notified whenever these videos get posted, and also gives you an opportunity to see which stocks in the S&P 500 have overbought and oversold cluster signals. In addition to YouTube, we're heavy users of Twitter. I would encourage you to follow me. My handle is @BrandonVanZee. And thank you very much to everybody who does click like and retweet on these Market Outlook related tweets that we post out there. Lastly, we have a presence on Facebook as well. Feel free to join us at the web address that's embedded in the logo in front of you. All right, with that, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up in front of us here if you are a premium member of Market Scholars and want to follow along at home with your own charting package. This particular chart setup is basically a four-grid that will look at the four major U.S. equity indices kind of side by side by side by side, and that way we can kind of point out little differences here or there whenever we might see them. Now, as a reminder, the background colors of the charts will let us know visually whether we have a bullish posture or a bearish posture from an intermediate term perspective using the market forecast technical indicator, which can be found over on Thinkorswim or other TD Ameritrade related resources. The market forecast indicator is that little indicator that you see at the bottom of the four charts there. Well, as you can see, the background color of all of these charts continues to be green, and that is a sign that we continue to have a bullish intermediate posture on all of our charts out there. Now note that we have rolled over a little bit here in the last 4 days or so with most of these indices, but nonetheless the trend from an intermediate perspective has not been disrupted to any major degree. You can see that we're still largely trading above higher lows that were established here at the end of June, and so as long as those are held and maintained, we'll continue to assume that stock prices will drift higher, unless of course there is some sort of major geopolitical event, or, you know, as I mentioned in the intro, maybe Jay Powell says something that disrupts what the market's expectations on interest rates are. So we always have to kind of stay vigilant on a daily basis as towards what could be taking place and where our risk is in our various portfolios. But right now we are kind of in the summer doldrums, a little bit quieter trade, not a whole lot of activity or volume, but the drift continues to be to the upside. You can see that the moving averages are all colored green right now as well, and that is a reminder that price is above a rising moving average when that occurs. In other words, the path of least resistance continues to be to the upside there as well. You'll also notice that while we don't talk about the market sentiment posture all that often, because it is a longer term view, so it's not necessarily something that traders are going to use all that much, but for those of you that are kind of longer term investors, perhaps the market sentiment can give you some stress relief, as well as you notice that we do have rising market sentiments on 3 out of the 4 indicators, or 3 out of the 4 market indices, I should say. The one exception of that is the Russell 2000. The market sentiment line is at 42 and falling. The rest of them, as you can see in the label here, the numbers and the metrics are rising. That is considered to be bullish. All right, let's go ahead and take a look now at our next chart setup, and this will be chart 4C. This is our 3 green arrows chart setup. As a reminder of what 3 green arrows is, it's just 3 different technical indicators. In this case, the 30-day moving average, the MACD histogram, and the stochastics. And the background colors of the charts will determine whether we have 3 green arrows or not. So right now, it's kind of a mixed bag. As you can see from a 3 green arrows perspective, we do have 3 green arrows on the S&P 500 and also on the NASDAQ composite down below here. However, over here on the Dow Jones and also on the Russell 2000, we do not have 3 green arrows. There we have a mix of green and red arrows. In the case of the Dow Jones, the red arrow came into play here a couple of sessions ago on the MACD, telling us that there's maybe a little bit of a loss of momentum there. And then on the Russell 2000, the red arrow that pushed its way into our conversation is on the stochastics there. And that is a way to kind of determine whether prices are generally closing near the highs or lows of their various ranges out there. It's a way to try to determine whether the bulls or the bears kind of are controlling the market right now. So on the whole, we still have a largely bullish picture with these 4 indices, but there are a couple little things here and there where there's some flies in the ointment with the Russell 2000 stochastics and the Dow Jones MACD that we'll want to keep our eyes on. Let's go ahead and now move on over here to our next chart setup. This will be a longer term chart. This is chart 4D. And as a reminder, these are 3-year charts that you're looking at here, and each one of the candles represents 1 week in length as opposed to 1 day like the other charts we've looked at thus far. So the biggest news story from this perspective has been what's been going on with the Russell 2000. As I mentioned to you midweek last week, there has been a bullish crossover. Now note, the Russell 2000 has been the laggard amongst these 4 indices here in the United States. You can see that most of the other indices have hit highs here recently. In fact, you can see it was just last week we hit a high on the Dow Jones. Just last week we hit a high on the S&P 500. And while the NASDAQ wasn't able to do that last week, it got very close. And even without doing it last week, it was able to hit a high back here at the end of April. You'll notice with the Russell 2000, the last time we hit a high on it was way the heck back here in August of last year. Yes, that is correct. We're almost at the 1-year anniversary of not hitting a new high on the Russell 2000, whereas all the other indices continue to kind of chug higher for the most part. Obviously, the move that we've seen over the last year on most of these indices has not been as aggressive as we saw in, let's say, 2017, where it was just kind of a one-way trajectory higher. We've had more ups and downs over the last year, but we still have positive results over the last year. So for those of you that have braved the storm and kept most of your portfolio either invested or largely bullish when you have been more actively trading, hopefully that has benefited you more often than not over the last year. But with the Russell 2000, that's not necessarily the case. You're still, down from where you were just a year or a year and a half ago there. So anyway, Russell 2000 is a bit more of a question mark in terms of its true north trend right now. But on the positive side of the equation, we did have this bullish crossover. If I were to right click on that chart, maximize that cell, you can see it in a little bit greater detail there. Notice the orange line, which represents the 10-week moving average, crossed up and through the blue line, which represents the 40-week moving average. And that is generally a sign of strength, or at least that's the perception there, as the more sensitive line is moving more positive than the less sensitive line in this particular case. So we had a very good idea last week that that was going to happen. However, just want to make sure that we're all on the same page here. Remember, it's not official until the week ends. And so since David and I were not here on Friday, just that I would mention it officially right now, it is true. We ended the last week with a golden cross on the Russell 2000. The question is where it takes us. As you can see, we've got overhead resistance here on the small cap index that dates back to both February and April time period, which is our first resistance area that we're going to have to encounter before we start pushing up to some of these other areas up here, if it decides to go that direction. Remember, there are no guarantees. We could just as easily roll over at this point as well. You can see we're kind of stuck in the middle of this range that we've been finding ourselves in with the Russell 2000 for the last 2 or 3 months. So, but, you know, again, to reiterate, slightly bullish tilt now towards the Russell 2000 now that we've been able to see the 10-week moving average cross up and through the 40-week. All right, let's go ahead and now take a look at some of our 12-grid analysis, starting with chart 4E. And as a reminder, when we're looking at these 12 grids, the background colors of the charts will determine whether we have a bullish or bearish posture using the intermediate line on the market forecast technical indicator. The pink background charts mean that we have a bearish posture. The green background charts mean that we have a bullish posture. So some of the areas we've been watching recently, of course, have been Treasury yields. It's been the biggest story, at least from my perspective here over the last couple of months, as it's been a one-way trip lower there for Treasury yields, and then inversely a one-way trip higher for bond prices themselves. Remember, those two things work inversely from one another. Now, you will note that Treasury yields were up a bit today. They were up nearly 1%, but we still remain just a hair below that falling moving average, and despite the move higher, it did not change the posture. The posture remains bearish at this time on the U.S. 10-year Treasury yields. Over here on the bonds from a foreign perspective, they were down a touch today, not much, but just a little bit. They've kind of flatlined for the last 3 or 4 trading sessions or so, but remain largely embedded into that uptrend right there. Somewhat of a surprise today were the REITs. Notice over here, VNQ had a very nice day. In fact, we've had a very nice bounce for the last week and a half off of these low points where, you know, it wasn't too long ago, this trend looked like it was in jeopardy of ending here. Kind of pulled itself together here right when it needed to most, and we shot nicely higher on REITs. And again, we'll be talking about REITs in our trade application example here in just a little bit. But I found that to be somewhat interesting just because usually when you see interest rates going higher, REITs struggle on a relative basis. Now, of course, that is not going to happen every single trading day. Over time, it generally does have that kind of inverse correlation. As you can see, TNX has largely been going lower over the last 3 months, and VNQ, the REITs, have largely been going higher. So while it doesn't have an exact inverse correlation every single day, usually over longer periods of time, you do tend to see that. Other things to be aware of, down below here, the dollar has been of interest to a lot of folks as well. It did look like for a while the dollar wanted to start going into a downtrend. You can see we had a high here and a lower high here. We then had a low here and a lower low here. So that was the formation of a very infant downtrend that was taking place. Well, note that this bounce back, this reversion bounce, has taken it all the way back up here to this prior resistance area where UUP hit back on June 18th. So if UUP does go up again tomorrow, there's a very good chance that this infant downtrend will already be disrupted. So we're at kind of a breaking point as it stands right here, just a hair below the highs from the 18th of June. So I'll be very curious to see if we'll be able to break through that tomorrow, or whether that will be used as a resistance area to send UUP lower. From the commodities perspective, gold has been on a nice run here recently. It really didn't do much of anything today, but nonetheless has been retaining its gains that it's been building upon here for the last month or two. DBA, which is a lot of agricultural commodities, hasn't really been doing a lot either. It's kind of been a difficult chart to trade. Obviously, if you're a little bit more aggressive from a swing trading perspective, maybe there's been more opportunities, but you haven't really established a strong trend either up or down on ag commodities here recently. And then crude oil had been in a strong downtrend. However, the more recent price action has been a bit more promising as we're starting to establish a bit of support above that moving average there. And the longer we can do that, the greater the chances that the moving average itself will start bending a little bit higher there. So promising sign there. Also note that we do have a bullish intermediate posture on crude oil as it's trading at 58.6 6.7 or 6.5 and rising. Of course, these are the futures contracts I'm looking at here, so those numbers will change in real time as well. All right, let's go ahead and take a look at our next set of 12 grids, and this time we're going to take a peek at the foreign stock markets. All right, so as we pull these up, it's a bit more of a mixed bag here as well, a smattering of pink and green background colors here. Brazil has started to come alive here yet again. Note that EWZ is the chart in the upper left there. And we were up about 1% with Brazilian stocks here today. In fact, one of the stocks that I've been kind of keeping my eye on lately that's had quite the strong trend is PAGS. And as you can see, that's just been a one-way ticket higher. So keep your eye on that kind of payment providing company there in Latin America. But anyway, EWZ as a whole has been quite strong here recently as well. It's been up 4 days in a row, bouncing up and away from that rising moving average. And you can see that the moving average is colored green to remind us of that, and the background color of the chart is also green. So, you know, you got a lot of things working for you in terms of momentum with Brazilian securities right now. Russia had been a very strong leadership group. You can see that some of its momentum has fizzled a bit here recently. Now, it hasn't gone down and broken through support or, you know, raised any serious red flags yet. It's just kind of tapping on the brakes a little bit here after a very strong move higher. So, you know, as long as it can maintain these elevated levels without breaking down and breaking through support areas, it might be just catching its breath for another big move higher there. Other areas of interest, Israel had a nice day today. It was up over 1% here today, and you can see it's starting to establish a nice pattern there. In fact, that's not a perfect textbook example of an inverted head and shoulders pattern, but it gives me the impression of that, and that is a reversal pattern where you would expect prices to resolve themselves to the upside. Note that on Israel, we now have a bending moving average higher, and that moving average is green because price is above that rising moving average. So perhaps there is something to this reversal here, and it's not just a flash in the pan. Maybe there's something a little bit more substantial going on here with EIS and Israel securities in general. I think there's a stock WIX that has been doing quite well here, Wix.com, that you might want to keep your eye on there as well. All right, let's go ahead and take a look now at U.S. markets. This is chart 4G. And as we look at the U.S. markets, you'll note that there's only one pink chart on the board, and that is energy. And energy has kind of been in the doghouse for a long time. In fact, I teach a class called Top-Down Trend Trading for our premium clients here at Market Scholars every Monday. And we just come into class every Monday shaking our heads, just astonished that energy just cannot seem to get out of its own way. In fact, I'll bring that up here briefly on the internet as a reminder. I produced this sector selector over the weekends. As you can see down at the bottom, energy has been dead last the entire 3-month period that you see on this particular graphic that takes us back to April here. Last place. It has not even gone up to second to last. It's never given us any sort of hope whatsoever. So energy has been just beaten into a pulp here in recent months. And, you know, it's not only just this last 3 months, it's really been the last year. Energy has not been a focal point for our Monday class because it has not been in the top 3 sectors for an entire year. It's just quite remarkable. A lot of times you do see a lot more sector rotation that's taken place. Even on this graph here, you can see technology was once first. It came all the way down here to the 5th slot and went back up to number 1. Healthcare is even more dramatic. Healthcare went from second to worst all the way up to second best. And you can see that financials have kind of been all over the board as well. That's more normal behavior when you see that rotation taking place on a multi-month process like that. What's not normal is to have 1 out of the 11 key sectors out there just stay dead last without budging the entire time. So it's truly been a house of pain there for energy companies. whereas we've seen technology, healthcare, and financials come to life a little bit more. Also, while I'm over here, I do want to say thank you to everybody that clicks like on Twitter for these videos. Remember, if you are watching these videos on the marketscholars.com website, you can just click like right there directly below the video for Twitter, or if you have a Facebook account, you can click the thumbs up by clicking this graphic directly below there as well. We try to make it nice and easy for you since we do appreciate your guys' engagement from a social media perspective there. And remember, that benefits you as well. The more that you engage with this content on social media, the more that companies like Twitter and Facebook will know to push you that content in the future. So if you get in the habit of clicking like every single day on Twitter for these market outlook videos, then they'll be sure to always bring it to your attention on a daily basis as well. At least that's how their algorithms are supposed to work. Also, you can see that if you want to subscribe to our website itself, you can sign up for a free account if you want. Now, obviously, it's not going to give you access to all the premium classes that we teach, but it would allow you to start participating in the Market Outlook Forum here. And it will also allow you to be ready whenever we do make a switch in the future, where a lot of the longer version of this video will be available on our website as opposed to how we've been doing things here more recently. Also, taught my dividend growth investing class earlier today. That is now posted. We focused on the information technology sector for those of you that want to check out that recording. David also had his directional options strategies class earlier today, so check out that recording. Tomorrow he's got his options inventory trading class at 11 a.m. Eastern Time, and then I've got my strategy lab class at 2 p.m. Eastern Time. So lots of good stuff coming your way if you are a premium member of Market Scholars. All right, let's get back on track now with the Thinkorswim charts. So a couple of the places that impressed me here today. First of all, real estate was a very strong category here today. In fact, if we were to look at the Market Watch tab, these don't track the ETFs exactly because remember, the ETFs are market cap weighted towards the S&P 500. These particular sectors here are kind of geared more towards the S&P 1500, so it's a broader measure of strength from a sector perspective that we're looking at here. But you can see that real estate from this perspective was the leading sector. So if I were to sort that again, real estate is up there at the top, and at the bottom we did see materials. From the charts perspective, here's what that real estate chart looks like. A very strong bounce off of that general 30-day moving average area right there, and we're back to approaching those prior highs there as well. So that is one of the stronger looking charts there on the board right now in real time. Other areas that are doing pretty well, discretionary also looks somewhat intriguing. Notice that discretionary has actually been up about 5 days in a row if you're using XLY as your proxy. We are at new multi-month highs here on consumer discretionary as well. So that one seems to be giving some positive mojo. And we also had some pretty big days there out of communications and technology. So, on the whole, these charts look pretty decent. There's some pretty strong trends that we're looking at here. Of course, the exception of that being energy, as I mentioned before. All right, so with that information out of the way, let's now start talking about our trade application example for the day. And as promised, that's going to come from the real estate space. So again, it's going to come from this area right here, one of the stronger areas of the day. And I wanted to identify a stock that I've actually kind of talked about a couple of times for those of you that were listening closely on these videos over the last couple of weeks, but I haven't actually taken an official trade on it yet. It's just something that's been on my radar screen of, it's impressed me with its strength. So ticker symbol is IIPR. Now this is a bit more of a controversial REIT. A lot of REITs are quite mundane. They've been around for a while and they do everything from apartment complexes to hospitals to industrial complexes, etc. This one's a bit more controversial because this is a cannabis-related REIT of all things. There's a whole new industry that is hatching in front of us with the legalization of marijuana across the country here in the United States. In fact, across the entire country of Canada, from my understanding as well. So, with that comes both opportunity and, of course, also risks. There are going to be a number of companies that probably end up failing in the marijuana industry in the future. Just like we saw a lot of companies like Pets.com and other types of superstars from the .com era ultimately fail as well. Now, there were a few companies like Amazon and Cisco and others that ultimately turned out to be huge home runs for investors, but the problem was back in the early 2000s, we didn't know which were going to be the big home runs and which were going to end up in the dustbins of society. So that will likely happen again with marijuana stocks. It's a very difficult place to trade because a lot of them are penny stocks, and they don't have a lot of liquidity, and you get the impression that eventually some of the bigger players out there will either start selling their own products or buying out competition. So there's just a lot more balls in the air when you start a brand new industry kind of from scratch, in this case from a legal perspective. So this particular company, IIPR, is a REIT that focuses on cannabis companies. And obviously, some of you have heard the analogy in the past where you've got, the gold rush of California that actually ended up bankrupting a lot of people that were looking for gold, but there were companies like Levi's and others that were supplying the miners that ultimately did very well during that time period. So this would be a way to say, okay, interested in the cannabis space, but a little bit nervous that I would pick the wrong marijuana company, and that would be the one that ends up going bankrupt in the future. So this is kind of like the supplier in a way, because these particular properties can be used by a cannabis company that ends up going bankrupt because they don't know what they're doing, but then could immediately be replaced by a brand new cannabis company that does know what they're doing and ends up being very successful. Now, whether that all plays out or not in the long run is anybody's guess, but that's kind of the mindset there. And you can see that this particular stock, or REIT in this case, has certainly caught the public's attention. Ever since really this candle right here at the beginning of June, this was a launch off of that moving average, and it ended that particular day at $91. You can see that just since the beginning of June, we've gone from $91 to $132. This stock has been doing very, very well, and while it has cooled off here more recently, notice that it has not given back a big chunk of those gains. It's largely just gone sideways. Today was a very nice looking day for the company. It was up 6% to benefit along with a lot of its competition there from the REIT perspective. So what I thought we would do here today is what's known as a bull put spread. Now, obviously, some of you might decide you're just going to buy the company and use stop losses and different things like that, because obviously there is going to be a lot of risk with this company as opposed to some of the more established REITs out there. But what we're going to do to try to define our risk is use options instead. Now, note that the options are not overly liquid. So that is one thing that I will warn you of. I was somewhat impressed with the options here from the July contracts perspective. There are hundreds of contracts, as you can kind of see over here, but the August ones don't have as many. There's a couple here and there that have 100 or more. So like right there, the 115 puts have over 100 contracts in open interest. The 105s do as well. And then you've got a couple of them over here on the call side of the equation as well. But just want to point that out because some of you are going to have rules that suggest, hey, I don't want to dabble with lower liquidity types of names when you're options trading. And by all means, if that represents you, don't take these types of trades, right? So what we will do in this case is not put in a market order. We're going to put in a limit order. And if we get filled, great. If we don't, that's fine as well. There's always there's more fish in the sea, so to speak. So if we look at this particular trade that I got loaded up down below, this comes from the August monthly contracts with 38 days left until expiration, where I'm selling the 115 put and I'm buying the 110 put. Now what's happening there is I'm receiving a credit of $1.15 or 115 bucks. That is right around that 30% return on risk. In fact, if you round it up just a hair, it's exactly a 30% return on risk there that we tend to shoot for with these credit spread types of trades. For those of you that are newer to credit spreads, what we're trying to say here is that this stock that's worth $132 right now, if it can stay above $115 for the next 38 days, then we get to capture 115 bucks. Where the trade goes wrong is if this stock fails to be bullish going forward for the next 38 days and instead starts torpedoing lower, and that could happen. Remember, what goes up very rapidly can come down very rapidly as well, which is the nice thing about this trade because we do have a defined risk trade here. But nonetheless, if this stock were to plunge down to $100 per share, we're covered beyond 110. So that's the reason we're buying the 110 put as part of this trade. So if we were to look at the confirm and send here, note that our break even is 113.85. So theoretically, if this stock can stay above 113.85 for the next 38 days, we should be able to end up making some money on the trade. If it falls below 113.85, then we would end up losing money on this particular trade here. Okay, so again, our max profit is 115 bucks. Our max loss is 385. So if something terrible happens and this stock goes down to $100, our worst case scenario right here we can identify as $385. So I'll go ahead and send that in and see if we can get filled first thing in the morning. And again, just to give you a heads up as to where the 115 strike is, somewhere in this general vicinity right here. Remember, our break even is closer to 114 or a little bit below it. So it'd be closer to that area that I'm kind of circling on the chart. So in other words, as long as you believe this stock stays above kind of its area that it was breaking out towards here on the 17th of June, then this is a trade that could end up being a successful one. All right, well, thank you for joining me here yet again tonight. Remember, if you got value out of the video, we really appreciate it when you click like there for us on Twitter. Remember, David will be back with you tomorrow, but we do continue to have bullish markets for the most part right now. Obviously, if things change, we'll keep you posted. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.